Welcome to Market Movers. I'm Jim Urio, and we are days away from our first glimpse at 2019 employment data with Friday's NFP. We're looking at using E-mini options to either hedge risk or create additional opportunities to a binary event like this. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Okay, so the NFP numbers for several years have been relatively consistent. Well, at least the estimates have been incredibly consistent. It seems like 180 is the estimate every month. And the results themselves have been consistent too. If this breaks trend with a heavy downside number, because it seems like there's lots of negativity in the air, but employment's been consistent, what does that do to the stock market?
It probably gives the market maybe a little bit of a relief here, Jim, because I believe that will motivate the Fed, which is focused on employment, focused on inflation, to maybe take that long-awaited pause because of the fact that, as you mentioned, other economic data has been slightly weakening.
No, and I agree with you on that too. So now, conversely, let's say it comes in relatively blockbuster. What happens then?
That might actually be an interesting problem, at least as far as the Fed's concerned, because being data dependent, being on the path they're on, a strong non-farm payroll, I think, actually backs them up to maybe do some more rate
Here's
hikes.
what I think is best for the market: mildly better than expected, so we can believe that the Fed. We believe that the Fed is moving away, but we also want to believe that the market's not crumbling too. Does that make any sense?
It does, and I believe that's also part and parcel of what the Fed is going to do as far as their messaging, which is on the back of a non-farm payrolls data report as we see Friday.
Now, before we dive into our trade discussion, I'd like to point out, with all market movers, it's important to view these as examples that allow you to see different ways to use futures and options products to either manage risk or create additional opportunities, not as recommendations or advice. Prices and movements will vary. When we just priced these out, the March ES was trading 25.05, which was up 30 from where it was a couple hours ago, so it's all over the place. Scott.
It looked like we were going to have a rough day today, didn't it? Maybe actually something that was going to be one of the worst trading starts at the beginning of the year that we've seen in many years, but lo and behold, the S&P 500 has shown some strength here, which is interesting, Jim, because of the fact that when I was looking at my expression today and trying to figure out some levels and trying to figure out some good pricing, there is a lot of it out there. It just depends on how you want to express yourself, my friends. So today, Jim, looking today at buying the week 1 Monday 25.25, 25.50 call spread for about 8 ticks. This trade, if you put it on, risks about 400, make potential 800 if you want to express yourself somewhat bullishly into the number. Has the ES underlying about 25.05 you mentioned, expires January 7th. Why that level, Jim? If you look at that high in early December in the ES, all the way to the trough in, say, mid to late December, this is about a 50% retracement of that pullback. So to me, that's a level that maybe we could kind of sneak up to here in light of this number that's coming out Friday.
And I like this because of the 25.50 level. I think 25.50 to 2600 is an important level. It's going to be hard to chew through that on the upside. So I don't mind this trade at all, even though mine's going to be the other way. And again, when we're looking at these, it's just risk reward. It doesn't always have to necessarily mean that's your short, medium, or long-term bullish or bearish thesis, correct?
Nor does it. And also,
Right.
it's one of these expressions that you should probably manage along the way, even though the expiry is so close because of the fact that volatility is so prevalent.
Right. So I'm looking at buying the week 1 Monday, the 24.25, 24 even put spread. This one's only 3 ticks. Now, I know we're 75, 80 ticks above it right now, but there's 3 days in this. This market can move 75 ticks in a blink. We've seen it before. It risks 150 to make 1100. Thoughts?
The risk reward's great
Yeah.
if it does happen to go your direction. And that's, again, an issue with the volatility that's out there because of the fact that things are moving so much. It really doesn't matter these days. I think when you look at expiration just being a few days away, volatility is certainly one thing that's going to maybe potentially be in your favor.
Right, and this is the thing that jumped out on me the most, is not necessarily that I'm bearish. I'm probably still a little bit bearish as long as it stays under 2600, but this was a risk reward play.
Absolutely. And the thing to think about for Friday, maybe not so much that headline number, which, give or take 10,000 could be 175K
Sure.
added, right? Look at the wage growth numbers, because that really is the number that points into how the Fed is going to react because of the inflation data they're working on.
I like it. Thanks for joining us on Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.